All right, good evening, class. Welcome to our taxation class this evening. The last time we started this topic, taxation of business income, capital allowances. And so we did the capital allowances for sole proprietor, partnership, and company. All of them are business income. We saw the rates used in capital allowances, the initial rates, and the annual allowance rates. Then we saw how we could calculate them and do proration for the first year when we are doing annual allowance. We also saw the basis period for capital allowances, which are the basis period for profits and losses, except for the fact that there is never overlapping period nor a period where there is gap when dealing with capital allowances. And we saw how we will treat any overlapping basis period between 2 years or when there is a gap. We saw how capital allowances basis period deals with that. We also saw restriction on capital allowances, and we said it is 2/3 of assessable profit. Okay, so we also said that it is the restriction applies to every company except those that are involved in agriculture or manufacturing. And so when you are dealing with any question and you see that there are a manufacturing concern, just know that restriction does not apply to them. Then we did something called the carryback of capital allowances when there is cessation of business. We said when there is cessation of business, the business has come to an end, you are standing in the ultimate year. You need to carry back your capital allowances that are unrelieved as at the ultimate year backward for 5 years. After 5 years, if the unrelieved capital allowance is not fully utilized, anyone is seen to be lost forever. Then we now did exercises and look at what we did in exercise 1. First of all, you determine basis period for profits. Then you use the basis period for profits to determine the basis period for capital allowance. After doing that, you fixed in all the capital allowance, all the qualifying capital expenditure that were bought in the basis period for capital allowances. You put them there. Then you try to compute the capital allowances first for those period. Then you come back to compute the assessable profits and then the tax for those period. Okay, these are the things we did here. And we also saw how to demonstrate the carryback principle. The carryback principle, we saw that when the profits, when there's no profit and the capital allowances are accumulated and cannot be relieved, you find out that you bring them backward, starting from the penultimate year going back. And as you are bringing them backward, you are bringing the taxable profit from which you charged tax before. The taxable profits from where you charge your tax before, you bring it back and you use it to clear your capital allowances brought backward. That will make your taxable profits to be 0 so that no tax will be charged. And if no tax is charged, it means that any tax you've paid before is supposed to be refunded to you because normally your taxable profit is now reading 0. That is how you do for 5 years until you relieve the capital allowances. Okay, and I told us to study skills past question November 2015, question number 1. If you've done that, you will see something similar. So we entered a new topic called taxation of business income, part 3, loss relief. Loss relief. Okay? Loss relief. There are two kinds of losses that we are going to be talking about. We are talking about the current year loss and the carry over loss. We also call it the carry forward loss. So the losses for individuals and the losses for companies. Now, losses for individuals simply means individuals that are sole proprietor or partnership. These are individuals that could experience loss. For example, you are dealing in a trading business, a venture or enterprise. You are also owning a house where you collect rent. And you have a cassava farm also where you also sell the produce. Okay? Now you are into you're into three kinds of business. Now, there's a possibility you can make loss in those business. Now, when you make losses, these are losses for individuals. When you make a loss for the current year, it is called current year loss. Now, in current year loss, what happens is that if your trading business has a loss, and perhaps your rental income has profit, your other form of income, maybe employment income, or maybe income from your farm has profits, you can net the loss from the profit for that year. So that means you're trading, or let's say, for example, you have three different businesses. So one of the business makes a loss. You can aggregate the profit with the loss together and get a combined loss or combined profit, whereby the profit has assisted the loss or has, shared the burden of the loss for the current year. That will mean that if they cannot share the burden of that loss fully, that loss will be carried over to the next year. Now, when a loss is carried over to the next year, it is called a carry-over loss. Now, we are still talking about individuals who have now experienced a carry-over or carry-forward loss. What happens to an individual who has a carry-forward loss? Let's say business A was the business that made loss. Business B and business C made profit. And they bore the burden of the loss of business A. And they could no longer bear everything. So it is giving net loss in the question. It is the combined thing is a loss because of that business A loss that is more than the profits of business B and C. Now, when the business A carries the net loss over, it cannot aggregate it again. It can never aggregate that carry forward loss. What will happen is that anytime it makes a profit, that is when it is going to relieve that carry over loss. So it's only current year losses that are borne by other business. So let's say in 2010, business A made a loss which affected everybody. And there is a carried forward loss to 2011. What happens in 2011 when business A makes a loss? That 2011 loss is a current year loss. But the one brought forward from 2010 is a carry over loss. Only the current year loss can be aggregated and the burden borne in the current year. Carry forward loss are to be carried forward and be borne only by that same line of business. There is an exception of this rule. The rule is if a rental income, you make a loss for rental income, the loss cannot be borne by other form of business in the current year. It will be carried forward to the next year. So, summary, losses for individuals. Individuals can experience current year loss, which can be borne by other lines of business. Individuals can experience a carryover loss, which will be borne by that same line of business. Okay, so that is for individuals. Now coming to companies. Companies do not experience current year loss. For one reason, companies are normally charged on preceding year basis. Any loss that they experience must be carried over. Every loss they experience must be carried over, and it cannot be used to set off on another line of business. This is because companies do not undergo current year loss. So there is no form of aggregation. So if business A makes a loss, it must carry its own burden. It will take it to the next year. Other businesses can make profit and the loss will not affect them. Business A will continue to carry its loss until it makes a profit to relieve it. That is what companies do. Now, there are rules for loss relief. What are the rules? Trading losses to be deducted from assessable profits of an assessment year shall not exceed the actual loss incurred by the company in the previous assessment year. Okay? Now, it means that if you are starting your business, in year 1 you made a loss, year 2 you made a loss, year 3 you made a loss, and they are accumulating. In year 4 you made a profit. All the losses you are bringing to accumulate to relieve from the profit of year 4, the losses cannot be greater than the actual loss. We will see that when we are doing question number 1. What I mean that your loss cannot be greater than the actual loss. Okay? Losses are not aggregated with accessible profits in the computation of company's total profits. So it means that when you are a trading loss from one company's source of profits cannot be used to set off another source of income. So that means one source of income will bear its loss alone. So when you are calculating the total profits of your business, you do them separately. You cannot just aggregate them together and, charge one tax. So you do that business, you find its profit or loss. You do the other one, you find the profit or loss. You do the other one, you find the total profit, and you find their tax. So you do not just bring them together and just lump them and get one tax. So if you have 2 or 3 business names, you do their profit and loss separately. Now, when trade ceases, that is in the cessation rule, there are bound to be maybe terminal losses, maybe due to insufficient profits. What happened? Let's take a cue from what happened to capital allowance. when there is a terminal, when there is a termination of business, so to speak, and the capital allowance has not been utilized or have not been fully claimed, what do? We take it backward for 5 years. That's for capital allowance alone. When we come to a loss, and the loss normally is supposed to be carried forward, but you have reached the cessation year, losses cannot be carried forward anymore. But what about backward? Can we carry loss backward? No, we can't. And so once we get to the cessation year, losses cannot go forward, they cannot go backward. So any loss you cannot relieve is seen to be lost forever. So what does that tell you? That the tax authority favors capital allowances more than they would rather give you capital allowances to reduce your profit or loss than allow you to relieve your loss. Okay, treatment of losses under commencement and cessation of business. On commencement or cessation of business, it will be observed that due to the application of the commencement provision in line with the company's basis period and assessable profit, basis period, one basis period could be used several times. That is the overlapping principle. Now, because of the overlapping principle, there may be sometimes that you will have losses that will seem to be exaggerated. So that is where that first thing I told you is usually happen. Now look at the following rules that should be applied. In any year where profits and losses have been aggregated, the loss shall be deemed to have been relieved to the extent of the profit used on aggregation. What it means is that each time you bring a profit and you bring a loss from the previous year, it means that that loss can only be relieved to the extent that the profit can carry. It means you have a loss of 200,000 and you bring a profit of 150. 150 is the profit, 200 is the loss. How much can the profit bear the loss? The profit can only bear up to 150. That means the remaining 50 will be carried again to the next year. Where on aggregation, a loss appeared several times, resulting in it being more than the original loss. The loss to be carried forward shall be restricted to the actual loss sustained as provided in the question. However, if actual loss has been relieved on aggregation, say in year 1 and year 2, the actual loss to be carried forward shall be adjusted for aggregation relief. Now, this is what they'll be testing you on whenever they give you a question on loss. Whenever they are giving you a question on loss, they are trying to test two things. One, if you have the knowledge of current year loss and carry forward loss. And two, if you have the knowledge that your loss appearing several times, making it bigger, cannot be more than the original loss when you are carrying it forward. That is the most important thing we are being tested on. Now look at this question. Let's be happy where we got this question. Let me set the solution so that we will have one place for the question and one for the, all right. Here's our question. Dominion Enterprises commenced business on 1st July 2004. The following are the results submitted to revenue. Now we see period ended. So this is commencement rule, business has commenced. So, you know, in commencement rule, we have the commencement year 1 and year 2 having overlapping, and year 2 and year 3 having overlapping. Now you see period ended. This is basis period. So what I will want you to do for me is you will come here and write year of assessment. Okay, write it towards capital allowances side. So if this is 2004, that means it is, okay, this is 2004, the business started. That means this is 2004 year of assessment. So this 30,000 is for 2004 year of assessment. This 40,000 is for 2005. This is for 26. This is for 27, and this is for 28. Capital allowances are always given according to a year of assessment. Profit and loss are not given that way. If they give you that way, they have done adjustment for you. But no, they will not give you that way. They will give it to you according to basis period, so that you will do the adjustment yourself. Required, compute the total income or loss. When we say total income or loss, we are looking at assessable profit less capital allowance. That will give you the total profits. And we are told to ignore right of election. So how do we solve this kind of problem? How do we solve this kind of problem? Now, this is a typical example of how losses are being solved. So let me solve this question. Now, if you look at year 1, the first year of business is 2004. So what we are just doing here on loss, we are summarizing profit basis period. We are also doing capital allowances. And now we are adding another skill, loss relief. All right, year of assessment is 2004 because the business started July 1 and the basis period is July 1 to 4 to 31st December 2004. What is the assessable profit? We are giving to us here as 180,000 naira loss. So you see it here in bracket, it is 180,000 naira loss. Now what happens to these capital allowances? This is 30,000. You cannot relieve it, so you are going to carry it forward. So you see here, assessable profit or loss carried forward. And now this is capital allowance carried forward. What is your taxable profit? Your taxable profits can never be less than 0. Taxable profit is the profit on which tax is based on. So it's either your profit is 0 or your profit is a positive figure. So you cannot say your taxable profit is a loss of 1/8. No, it is called profit. It is not assessable profit or loss. This is assessable profit or loss. You can put negative figure, but when it comes to taxable, they cannot tax a loss. So when it comes to taxable profit, whenever you find anything less than 0, if anything negative here, simply put nil or put 0. If it is 0, you put 0. But once it is a positive number, it becomes positive. So here it is nil. So that's one skill you've learned now. Whenever your assessable profit or your assessable profit less capital allowances is giving you a negative figure, your taxable profit is seen to be nil. All right, we take the next year, 2005. That is the year 2. It means that basis period will start from when the business started. July 1 to 4, we'll count 12 months to 30th June 2005. What do? We need 12 months accounts. And from here, this period to December is how many period? Is 6 months account. So this 180 here happens to be 6 months account. We need another 6 months from here. So we need 6/12 of 120, which is going to give me 60,000. So you see it here, 6/12 of 120, you give me 6,000. 6,000 plus 180 is going to give me a loss of 240. Then remember we had a loss from last year. We bring the loss of last year down, which is loss brought forward, 180. So if we add this year's loss of 240 to last year's loss of 180, we have a total loss available of 420. What do we do? Is this the true picture of the loss that we have carried forward so far? No. Mind you, the loss we've carried, we've treated so far, we have not cleared this 180, right? And we have not taken 60 out of it. So it is this 180 we have not cleared, plus the 60 we just introduced now, making 240. That is the actual loss, not 420. So you see what we are saying? Your loss must be restricted to the actual loss. So you see this 180 is appearing 2 times. It's coming from last year, and we're also using it again because of overlapping basis period. Meanwhile, this 60 is appearing just once. So it is this 60 and just one of the 180 that we're going to use. So we're not going to use that 180 2 times because we didn't make that loss 2 times. So that's the principle. So you have to be very careful. You ask yourself, all the losses you have been aggregating that you have not relieved up to the present, how many are they? Is it up to that thing that we are saying we are carrying available? If it is less, that is what should be restricted to. So we are going to carry this 240 forward to next year instead of 420. Now, if you look at it now, your capital allowance, we've used 30, which we didn't carry, which we didn't relieve. We are now bringing 40. So that is where this is the 40 for the year. This is the 30 from last year. It means we have 70 we have not cleared. We are carrying it to next year. And so your taxable profit is nil. Mind you, all these ones, the taxable profit are nil, their tax will be nil also. And their education tax will also be nil. Okay, let's get to the 3rd year. The 3rd year, we are going to be looking at the account ending date, which is 2005, ending of 31st December. Now, what is the year of assessment? 2006 year of assessment. Preceding year basis means the ending account must end in 25. And what is the account ending date? 31st December. So it will be 31st December 25. Then it must have started in January 1, 2005. So let's see. This is where we have January 1, 2005 to December 31st, 25. And how much is that? This is 120. So what do we do? 120 is our loss for the year. Then the loss brought forward is this 240 we carried. We brought it down here. And we bring it down here. We add it to 120. The losses available to us is 360. Then you ask, is that the true position? Because we've been aggregating losses for now. What do? We've been aggregating this 180, and now we are here, this 120. So we add 180 to 120, we have 300, which is lower than 360. So it means that 300 is what we shall carry to the next year and not 360. Mind you, each time they give you a loss in the first year or second year, this kind of problem will always occur. Now, your capital allowances, you have these 40, that is for the year, which is this one here. Then brought forward from last year, this 70,000, you bringing it here, 70,000. Add them up together, you have 110,000. Now, since you have 110,000, you cannot relieve it from a loss. So it means your taxable profit is nil. You go to the next year. The next year is 2007. Now this is 2007. It's going to be January 1 to December 31st, 26. So where is the figure coming from? The figure is coming as 140. Yay! We have a profit now. Let's see how the profit is going to cope with the loss. This is what we call the carryover losses. Now, for the year, we have a profit of 140. We are now bringing a loss from last period of 300. So what do we say? The profit will carry the loss as much as it can. It cannot carry the whole 300 losses. It can only carry the loss of 140. And what happens? It means that your resultant aggregate is going to give you 160 loss. So it means it's as good as your loss is 160. So your profit has reduced down to a loss of 160 because of that carry forward loss. Now, capital allowances, you brought 45 for 2007 year of assessment, and you are bringing it here with this 110. This figure here is brought forward. So it means that you are going to have available of 155. Now, since we have a resultant loss here, we cannot relieve the capital allowance. So capital allowance gets carried to the next year. Now, in the next year, which is 2008, this period will be January to December 27. Wow, we have another profit, 260. Beautiful. Now, what happened? We have brought in our 260 here, loss from last year, 160. Then the profit can carry the loss as much as it can. Can it carry everything? Yes, it can. It can clear the whole 160. The resultant loss is now 100. Wow. Now, what happens to capital allowance? Capital allowance for 2008 is 50, and you brought the 155 from last year. Everything gives you 205. So 205 is available, and you have a profit of 100. So that means some capital allowances can be relieved. But this company is not into manufacturing. This company is not into agriculture. What do? You will restrict 2/3 of accessible profit. Now we have two accessible profit. We have one of 260 here. We have one of 100 here. Which one do you use? You use this balance of 100. So you look for 2/3 of 100,000 to give you 66,667. So you write it down here. Also, you write it down here. The difference, there are different reasons why we put it in two places like that. One, we want to find after you relieve it from your capital allowance. If you have 205 capital allowances and you're knocking off 66,667, how many will remain to be carried to next year? 138,333. That's the reason for putting this capital allowance here. Now, this is where you are actually knocking it off. Where are you knocking it off from? From your profit. You have a profit of 100,000 and you have relieved 66,667. How much is going to be your total profit? It's going to give you 33,333. So it is based on here, 33,333, you find tax. So if it's a company, you look for 30% of the tax of the profit here. Then, if it is also a company, you look for education tax, 2% of this very accessible profit, not this. So there are two places, there are two uses of accessible profit. The very first accessible profit you brought for the year, that is what is used to calculate your education tax. But when you have knocked it off with loss and you get a resulting accessible profit, that is what is used for capital allowance. So get it clear again. Let me say it again. Your accessible profit, the one you have initially for the year, is where your education tax of 2% is based on. If you have a loss that you net it off and you have this 100,000, then that is this 100,000 is where your capital allowance will be knocked off from. That is where you'll be calculating the 2/3, not on this. So I believe we get a clear distinction. Okay, we now go to 2009. 2009, we have basis period will be 1st to December, 1st of January to December 31st, 28. We have 400,000. Yes, we have more profits, 400,000. But there is no capital allowance for the year. No capital allowance for that year. But meanwhile, we have capital allowance that is brought forward from last year. So when you have 0 for the year, you have someone brought forward, something brought forward, add them up. This is what is available. How many will you relieve? Once again, 2/3 of 400,000. The answer you will get will be bigger than 138,333. So since it is bigger, it means you can relieve everything. Then that means you can now relieve the 138,333. You write it here, you write it here. So finally, your capital allowance, everything is coming to an end here. And it is also being relieved, knocked off from 400. Your profit will now become 261.67. This is where you base your tax, company income tax. This is where you base your education tax. So this is typical of how a loss question will be set. This is a practical true to life question. Although this one asks you to look for just total profit, which will be how simple it may be, some questions might ask you to also look for the tax. So that means you now have to calculate your tax. So far, so good. We've looked at relief. We said we have the carry forward and the current year loss. And we said for individuals only have carry forward loss and current year loss. The current year loss, profit and losses are aggregated from other sources of business, fine. But when it cannot carry all, take it forward. It becomes a carry forward loss, which will be relieved from only that line of business. But for companies, we said companies can only practice carry forward loss, relieved from only that line of business. We now said rules about losses. Profits can only carry the amount of loss that it can accommodate. The remainder will be carried forward to the next period. And also, if you use a basis period multiple times and there are losses which appears more than one, then you have to use the actual loss. It's going to be restricted to that actual loss, which is to be carried forward to the next period. Capital allowances are only relieved whenever there is a profit, accessible profit, resultant accessible profit. If there are no accessible profits, it gets carried to the next year until it becomes relieved. Now, if you are looking at the terminal business, when the business is ceasing, profit, if you have profit, fine. If you have capital allowance relief, fine. What if you have a loss? That loss is gone forever. It is lapsed. But what if you have unrelieved capital allowances? You take them backward for 5 years. You start bringing back the total profit you've calculated before and relieving more capital allowances from it. They will be refunding your tax that you've paid before. That's how it works. So this is a short topic, loss relief. Now that we've talked about that, we will now enter a new topic, which is called taxation of employment income. Taxation of employment income. Now, employment income is the income that people who are working, people who are earning salary, they earn. Okay, we are going to be looking at what is called contract for employment and contract for employment and contract of employment. Contract for employment is when you are a vendor. If you enter that contract with a company, it means you are a vendor. You are a self-contractor. You are working for yourself. And so the company does not pay you salary. What the company pays you is your bill on your invoice, or they pay you a fee. For example, if you are an independent accountant, the company does not have a salaried accountant, but they consult you to do the accounting job for them. You are a vendor, you give them your bill and they pay you. That is contract for employment. Now, when you are now being employed and they are paying you regular salary, you are an employee, and that is what is called contract of employment. So under the payee scheme, it talks about contract of employment when we are into the employer-employee relationship. Okay, so what do we do? What are the distinctions between contract of employment and contract for employment? The contract of employment, when you are an employee, you get what they call remuneration. That is your salary, your bonuses, your allowances, and all that. But when you are under contract for employment, you are a vendor, you only earn your fees and you calculate your profit. Then, if you are an employee, contract of employment, your tax is on actual year basis. Why? This is because your payee is remitted on or before the 10th day of the new month. So it means January payee, your tax is deducted from source. As they're paying your salary, they would have deducted payee tax. We call it pay as you earn. January salary, they will pay it by February 10th. It is going to the revenue office. February salary, by 10th March, it is going. So that means if you are considering January to November, as at December 10, when you are paying November payee, you would have paid 11 months payee on the same year. It's only December payee which you pay the next year. So if you are paying 11 months out of 12 the same year, it then means that it is actual year basis. While if you are under contract of employment, you are a vendor, your basis for tax is preceding year. That is what they call direct assessment. What happens is that from January to December, you do your business. By January of the next year down to March, you have 3 months to prepare your account, assess yourself to tax based on the preceding tax year, preceding year basis. So you do your business, you assess yourself. So if you are a vendor, January to December of 2019, you'll be assessing yourself to tax 2020 from January to March. Then you pay your tax on a lump sum. Whereas as an employee, you pay 1/12 of your tax every year. Now, a vendor who is in business is expected to register for VAT. So you have a business name, you are using it to operate, you're using it to make money, you have to register for VAT. But an employee does not need to register for VAT. You don't pay VAT as an employee. Okay? And you do not terminate the appointment of an employee without notice. But you can do that to a vendor and just say, one day, please, I won't be buying anything from you anymore. But you don't do that for an employee. You must give him his benefits. Now, types of benefits, we have Nigerian employment, type of employment, rather, we have Nigerian employment. If you hold an employment in Nigeria, you are having a Nigerian employment. Then there is also what is called a foreign employment. Please read it up. So let me go to one other thing that is very, very important to us here, employment income. What kind of income can we call employment income? Employment income is any income you get by way of working as an employee for an organization. So what are some of the things you get? You get salary if you are working as a permanent staff. You get wages if you are working as a contract staff. Some people pay fee, fine. You get allowances, so you have housing allowance, leave allowance, clothing allowance, things like that. You also get gain. You also get gain or profits from employment, such as compensation for the loss of office. They give you compensation, they give you gratuity. They also give you bonus, okay? It means there's what they call productivity bonus. You did where they say, okay, they give you bonus. Sometimes they can give you shares. You can buy shares in the company as a big management staff, and they can give you premiums. They can also give you other benefits. We have cars, we have house, domestic servants. All these are benefits in kind. They also pay you pension. They pay you gratuity. Anything you get as a result of answering that title, employee, is an employment income. Now, employment income and business income. What is business income? Business income is the income you get for not being an employee, but you are working actively. Now, there are two ways you can work actively and get income. Either as an employee, where you are paid employment income. or you are into business for yourself as a vendor, as a professional, and you earn business income. So you are trading, you are doing partnership, you are earning income, that is business income. So when you add your business income, which we've just discussed, with your employment income, which we are discussing now, we have what we call the earned income. Now, earned income is the income you earn while you are doing one form of work or the other. It could be a trade, it could be a profession. For example, I am an accountant. I'm also teaching, so I'm earning the income from teaching. I'm also doing a vocation. Okay, now I'm also working for somebody in an organization, so I get employment income. All right, so earned income is made by actively doing something to bring revenue and not passive. So for example, if you don't go to work, you don't get paid. If I don't come to the Zoom class to teach, they won't pay me. So I don't just sit down here and do nothing and get paid. No. So each time I repeat that task, I get paid and income. If you are if you have a business where you are selling, maybe buying and selling, and decide to stay at home, like during that COVID-19 that they say people should not go to the market or to open their shop, people made no money because they were not actively doing anything, except those who were actively involved in trading in the internet. And that is also earned income because no work, no pay. All right, now let's look at, we've been talking about business income before, where we said it is income from trade. Now let's look at employment income more fully. But before we go to employment income, I will also have to tell you that there is another kind of income called unearned income. Unearned income are those income that is earned passively. You sit down, do nothing. Rather, you have sent your money on errand and your money is doing the work for you. For example, you buy shares in company. It's not every day you will buy the shares. You're not even the one actively trading in the business. You sit down, your shares is working for you. Even during the COVID period, they are paying money into your account. You are earning. Now, this is unearned income. Now, it includes income from dividends, interest, rental income, people who are collecting rent, whether there is COVID or not, people go to work or not, you sit down, you build your house once, you don't go back to rebuild the house, but people pay you yearly. Royalty, people who are singing song, who sang, for example, Two-Face, Davido, D'banj, Wizkid, Tiwa Savage, Banky W. They are earning royalty. For example, if there are labels that they are signed under sell their music, those ones will be earned income because if they don't sell, they don't make money. But those artists will not be singing every time. And so they keep earning as much as they are giving them royalty. So they are earning passive income. So when we have earned income, business income, or employment income, unearned income, which is from investment, add them together, we have total income. Now let's look at that employment income more fully. Now we have what we call cash emolument. Cash emolument is any income that comes by way of cash. Now it may not be by way of cash, so to speak. It could be cash, it could be they pay your bank through your bank, that's fine. they give you allowances, they give you gain, they give you bonus. Anything that you can quantify, you can get the monetary value, maybe you can cash on it. For example, your bonuses, they can pay your bonus into your account. Share of profit, they pay it into your account. Anything that is paid by way of cash or bank is called cash emolument. Now, not everything could be paid by cash. Some of them, they will rather give you the benefits. Let's say, for example, if they give you an overseas trip, all expense paid, as long as it is not monetized and given to you, then it is not cash emolument. If they monetize it and give to you, it now becomes cash emolument. If it is given to you in any way other than cash, you enter the trip, free trip, and you come back, free massage, free accommodation, it is now benefits in kind. Benefits in kind. Now, some of these benefits in kind could include living in a furnished apartment paid for by the company. Another one could be a gardener or steward or even a guard could be employed, be paid to do certain service for you. Okay? And that means you must be a very high profile person. Let me use an example of the Johnsons. If you are watching African Magic, for example, right now the Johnsons is going on. Let me use him as an example. Mr. Johnson is an essay to the governor. He is having an employment income. Okay? Now, they will give him cash, they will give him other benefits, cash emolument. Now, they also give him benefits in kind. He has a house where he's living, it's been paid for, furnished. It may not be everything that the government furnished. He may have his own furnishing, but some of them are furnished by the government, such that if you are terminated, if your appointment is terminated, you leave that apartment. Okay? Now, he has a security guard attached to him, a man called Mohammed. Okay? So that's a typical example. He also have a car given to him by government. After working for some years, the car may become yours. But that car was not bought by your own money, but is bought by the government or by the employer. That's a benefit in kind. So sometimes he may want to go on some trips. They will sponsor the trip for him and his family. These are also benefits in kind. So when you add your cash emolument plus your benefits in kind, that gives you your gross income. Your cash income, your cash emolument, your benefits in kind will give you what they call total emolument. Total emolument. That's the right word. Now, when you have your total emolument simply is another way of saying employment income. So your cash emolument plus your benefit in kind gives you your total emolument. That's employment income. Sometimes they say remuneration. Okay? Now, let's still use our example of Mr. Johnson. Let's say his wife Emuapo Johnson is a trader. Or even his son, Tari, the designer, is making money. It's part of the whole family. Let's say everything is coming to Mr. Johnson. And or Mr. Johnson himself, maybe let's say he has a store where he makes trading income. Or perhaps he has a farm where he makes other income. That would be business income. Now you now add your business income to your total emolument or your employment income. Now let's say Mr. Johnson buys shares or he rents a house. Okay, now that is going to be unearned income. When you now add all together, it becomes total income. No, it's not total income, it's called gross income. Gross income. So it is that gross income that will be faced with some deductions, which we will talk about later. So now let's remove all those other ones from the way. We're looking at the cash emolument and the benefits in kind. The cash emolument, it is easy to fix value on them because we already know the cash involved. But the benefit in kind, it is not easy to know what is involved. For example, assets that are acquired by the employer. Let's say the asset is a car. The car is owned by the employer. And you know, assets, they have some useful life. So the value of the car the full value of the car does not automatically becomes an income in the hands of the person who is using it. But what the law says that for car, or maybe yes, for car, money, furniture and fittings, 5% of the cost value is what is applied. Let's say, for example, 100 million naira car. 5% is 5 million. So it means 5% of that 5 million naira part of the car is added to, let's say, Mr. Johnson's cash salary to become additional income in his hand. So as long as he's using that car, enjoying the benefits of the car, 5% of the value of the car will be added as his income because he's enjoying it and he didn't pay for it. Okay, what if it is they don't know the value of the car? It means they have to look for what is the market value as at the date the car was bought. That's what they were going to use. Okay, what if they didn't buy the car? The company is not the owner of the car. It is being rented by the company. It is being hired by the employer, and it is being used by, say, Mr. Johnson. So it means that that car that is being hired, the hire fee, whatever they pay to hire that car, that is what will be added to Mr. Johnson's salary as income in his hand. What about accommodation? Now, if the accommodation is an asset owned by the company, okay, it means that the company is asking Mr. Johnson to stay in a house that is owned by the company. What happened is that the company is supposed to put it into business use and collect rent, but Mr. Johnson is living there free. That free is living. It's not just free, they will look for what they call the rateable value of that accommodation and add it into his salary. So let's say Mr. Lucky is living in a 3-bedroom flat, or let's say a 3-bedroom flat in Lekki. Now, the same kind of house is also available at, say, Ikoyi. The same kind of house is available at Ikeja. Another one at Ikosi. Then we have Ikorodu. I'm using Lagos axis. Their rateable value varies. These are the same standard kind of house. Yes, they built it the same, but the way they will value it at Lekki will be very high. And so it means the income that will be added to him will be high. If he says, no, let me go and stay at Ikoyi, to come down a little bit, but it will be high when compared to going to Ikeja, or compared now to coming to Ikosi, to be lesser than Ikoyi or Ikeja. Or if you say you go to Ikorodu, the value will be very, very low. So it means that in Ikorodu, somebody may be paying a 3-bedroom flat for 150,000 naira. But in Ikosi, you'll be paying 600,000 or 700,000. Maybe in Ikeja, you'll be paying close to 1 million. Ikoyi may be paying close to 1.5, 1.8. In Lekki is 3 million. That's a rateable value. It will be added to your salary as income in your hand. Okay? What if it's not the asset of the company? The company is the one paying your rent. Now, whatever the company pays at rent for you will be the income added to your salary as income in your hands. Now, if they employ domestic staff and you are not the one paying them, it's the company that is paying them, their services, their income is seen as income in your hand. Okay? Then, sometimes if you have a house that you provide, and that house is called staff quarters, that staff quarters is never seen as income in your hands because it is provided as staff quarters. Now, there are some benefits that are exempted from tax. These are benefits that are not taxable in the hands of the individual. One, any expenses in connection with providing of meal in any canteen for all staff. That's a non-taxable expenses. Any expense that has to do with provision of uniforms, overall, other protective clothing, those expenses are allowable. Then, whenever you change your residence as a result of changing employment, you are transferred from Lagos to Abuja, your expenses in connection to changing your residence, you move, and all that is allowable. Now we talk about other reliefs. There are other reliefs that is allowable in employment income. We are going to talk about 4 or 5 briefly. We will not be solving question on this. We'll just talk about this briefly so that in next class, we'll solve the question. The first one is consolidated relief allowance. This is statutory required by law. First of all, they will set aside 200,000 naira from your gross income, or they will compare 1% of your gross income, whichever is higher. Okay, so if you are earning 20 million, if they check 1% of it is 200,000, they will compare that 1% with 200,000, which is equal. So the rule is whenever your gross income is less than 20 million, whenever it is less than 20 million, just pick 200,000. But if your profit, your gross income is 200,000 or more, pick 1%. So they see 200,000 or 1% of gross income, whichever is higher on the one hand. Then you also add 20% of gross income. That becomes your consolidated relief allowance. The next one is pension. Any amount you pay for pension, it becomes allowable. Now, pension, the minimum pension is 8% of your employees' remuneration, monthly remuneration, restricted to basic, housing, and transport. So basically, these three items will form like 80% of your salary. Then they are taking 8% of it from yours, while the company will pay 10% from their pockets of your basic housing and transport. I call them BHT. Okay. Then we have National Housing Fund, which is like 2.5% of your basic salary. So 2.5% of your basic salary goes to National Housing Fund. Then we have the HMO, the National Health Insurance Scheme. So this is going to give you anything you pay on your HMO is going to be allowed. Then we have your life insurance and your gratuity. Then we have tax computation. By now, you should be familiar with this tax table. We're going to talk much more about the tax table when we are solving questions. Then there's something called minimum tax. Minimum tax is whenever you have an income that is lower than, whenever your tax is lower or you have no tax at all for the year, or it's supposed to be something else, but it's lower than that, you always look for minimum tax. When we are going to solve a question, we shall look at minimum tax. And now this is the formula for calculating your gross income, your gross emolument, your gross income, your chargeable income, and your tax. So ladies and gentlemen, we've come to the end of our class. The next class, we shall look at how we can solve questions having to do with employment income, because we know that employment income will form the bulk of your questions, form the big part of your exam. You will not miss employment income. All the things we've just learned, taxation of business income, basis periods, capital allowance, loss, employment income. I can beat my chest. You will see them in your exam. So that's why I'm taking these things step by step. It's going to be helpful for you if you look at this format. Now, before the next class, just look at this format and study it, so that when we are starting to solve a problem, you understand how this format works. So thank you so much. I'll want you to ask all your questions in the WhatsApp group. Okay. Yes, I'm going to, I won't respond to this question because, okay, I won't respond to this. All right. So I want you to look at this format, study it, and we'll meet in class the next time when we'll be solving question. Thank you so much and see you in the next class.